Hey everyone, welcome back to Corporate Decoder, where we dissect boring reports so you don't have to. Today we're diving into a report packed with numbers, shareholder details, and so many dates. Some reports tend to hide the juicy bits, others tell you everything in a way that makes it hard to understand, so we're going to decode it. And as always, if you like corporate insights without the corporate jargon, subscribe and join our Discord community linked in the description. It's a great spot to chat about this stuff with other smart viewers. This shareholder report paints a picture of how several Invesco funds, specifically the Invesco Charter Fund, the Invesco Diversified Dividend Fund, and Invesco Main Street All Cap Fund performed over the last 6 months. This report isn't just about bragging, it's a regulated way the company tells investors how well or how poorly their money is being managed. First, let's hit the high notes of Invesco Charter Fund. The objective is long-term growth of capital. That means the goal isn't quick cash, but it's more about steadily growing your investment over time. Now, when it comes to cost, the Class A shares cost around $50 for every $10,000 invested. So how big is this fund? We are talking about an organization with more than $3 billion of assets, which are split into about 73 holdings. This means the fund isn't sitting still, it's actively managing its investments at a rate of 21%. What's in their portfolio? Microsoft takes the lead, comprising over 7.3% of total net assets. Nvidia follows with around 5.47%, with Apple and Amazon clocking in at about 5.22% and 4.24% respectively. What does this mean? It shows a concentrated bet on big tech, not much diversification outside tech it seems. Now let's switch gears to the Invesco Diversified Dividend Fund. This fund is a bit different. The goal is long-term growth and to make some money right now. Class A shares are costing you around $41 of each $10,000 invested. We are talking almost 10 billions in assets, which are split into about 80 holdings, meaning that each one is a more diversified portfolio. Also, the portfolio turnover rate is at 32%, so it is a little bit more twitchy portfolio over Invesco Charter Fund. When it comes to the top holdings, JP Morgan leads the chart, Walmart and Philip Morris follow lastly. We need to take a look at Invesco Main Street All Cap Fund. Coasting around the same, each 10k investment would yield around $50 for Class A shares, with significantly less assets from almost less a third from the other two. The top holdings are mostly big tech again, with Microsoft and Nvidia, with Meta in the top 5 but slightly diverse. Let's talk about something called securities lending. Basically, it's like renting out your stocks. The fund lends shares to other companies and gets collateral in return, which basically means cash or government bonds of equal value is given for the rent of the stocks, but there's risk involved here if the borrower doesn't return the shares. They need to sell the collateral and buy back their shares and return them. Okay, so how does Invesco arrive at these numbers? It uses a combination of real-time market data and internal models, depending on the type of asset and how actively it is traded. And they use a 3-level categorization, levels 1, 2, and 3. Level 3 relies on the company assumptions about value since there aren't real public markets for it, as well as significant market price drop. That makes the price unreliable. Of important mention, there are also fees and expenses of managing the fund, which are waived to limit expenses. It is the company putting its hands in the fire so that the shareholder don't get burned. Alright, let's talk earnings and changes, the most important part. Invesco Charter Fund and Invesco Main Street All Cap Fund lost money to the investor. What does these imply? They mostly invested on companies that haven't raised that much money. Other point is that all of them are heavily focused on the US economy and the US markets. Now, to end our analysis, let's give our professional take. The fund is too focused on big tech. Without diversification, it reduces both stability and reliability. This is further exacerbated by the fact that these funds are heavily concentrated in US markets. Keep a close eye on tech's future, the AI hype might end among other dangers, and what happens with US trade deals and politics. So, while there appears to be an opportunity, there is too much risk involved. Alright, that's our breakdown of Invesco's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description where other people discuss all these forms. Thanks for watching. See you next time.